studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
This slide introduces one of the simplest and most practical compensation planning frameworks for owner-managers. Rather than starting with dividends and trying to work backward, many experienced advisors follow a structured sequence. The approach is simple. Determine the salary first, then decide whether additional compensation should be paid as a bonus or dividend. At the center of the slide, we see the 5-step process. The first step is determining the required salary. This is where the planning begins. Instead of asking how much profit should be withdrawn, the advisor first asks what planning objectives need to be achieved. For example, does the client need income to support a future mortgage application? Do they want RRSP contribution room? Is CPP participation important? Are there childcare considerations or other planning opportunities that require earned income? The salary amount should be based on these objectives, not chosen arbitrarily. Once the required salary has been determined, we move to step 2, reviewing corporate profit. At this stage, we evaluate how much profit remains inside the corporation after accounting for the salary component. Step 3 is determining whether additional cash needs exist. Perhaps the client needs more money for lifestyle expenses, investments, debt repayment, or personal financial goals. If additional funds are required, we proceed to step 4. This is where a bonus or dividend may be used to extract additional cash from the corporation. Unlike the salary component, which was driven by planning requirements, this stage focuses on flexibility and profit distribution. Finally, step 5 is creating the final compensation plan by combining all of the pieces into a coherent strategy. Notice the 2 panels on either side of the slide. The left side highlights the reason salary often comes first. Salary helps support mortgage qualification, creates RRSP contribution room, builds CPP participation, supports childcare planning, and satisfies earned income requirements. These are foundational planning benefits that dividends generally do not provide in the same way. The right side highlights the role of bonuses and dividends. Once the foundation has been established, dividends can provide additional cash, distribute corporate profits, offer timing flexibility, and facilitate shareholder withdrawals. The key lesson is simple. Start with planning needs. Determine the salary required to achieve those objectives. Then decide how to distribute any remaining profit through bonuses or dividends. This approach creates a more structured and intentional compensation strategy. Rather than allowing tax considerations alone to drive the decision, it ensures that the compensation plan first supports the client's personal and financial goals, and then addresses profit extraction in the most appropriate way. This slide explains one of the most practical principles in compensation planning. Salary often comes first because it creates the foundation for many important planning objectives. Think of compensation planning like constructing a building. Before you can add additional floors, you need a strong foundation. In this example, salary represents that foundation. At the center of the slide, we see a building supported by several structural pillars. Each pillar represents a planning benefit that salary can provide. The first pillar is CPP participation. Salary creates CPP contributions and helps build future CPP retirement benefits. The second pillar is RRSP contribution room. Since RRSP room is generated from earned income, salary helps create future retirement savings opportunities. The third pillar is mortgage income. Many lenders prefer documented employment income when evaluating mortgage applications. Salary can therefore play an important role in future borrowing capacity. The fourth pillar is earned income itself. Certain deductions, credits, and planning opportunities rely on earned income, making salary valuable beyond simple cash extraction. The fifth pillar is childcare planning. As we discussed earlier, earned income can be important when considering childcare expense deductions and related tax planning opportunities. Together, these pillars create a strong planning structure. Once that foundation is established, we can begin building upward. This is where dividends enter the picture. Notice that the upper floors of the building represent benefits commonly associated with dividends. Dividends can provide additional cash, greater flexibility, profit distribution opportunities, cash flow management options, and strategic tax planning flexibility. These are all valuable benefits. However, they generally work best when they are built on top of a solid salary foundation rather than replacing that foundation entirely. That is why the statement in the center of the slide is so important. A strong compensation plan is often built on a salary foundation with dividends added afterward. Salary creates eligibility for many planning opportunities. Dividends add flexibility. Salary establishes the structure. Dividends help customize the plan. This does not mean every client needs a large salary, nor does it mean every client should maximize CPP or RRSP room. The point is that salary should usually be evaluated first because of the planning benefits it creates. Only after those needs have been considered should dividends be used to provide additional flexibility and profit extraction. The key takeaway is simple. Salary creates the foundation. Dividends build on top of that foundation. And when both are used strategically, they can work together to create a stronger and more balanced compensation plan for the owner-manager. This slide presents a practical workflow that many advisors use when designing compensation strategies for owner-managers. By this stage, we know that salary and dividends each have strengths. The challenge is determining how much of each should be used. The process begins with understanding the client's personal objectives. On the left side of the slide, we see common personal goals, such as family financial security, lifestyle spending, retirement planning, education funding, and long-term protection. These objectives help determine how much personal cash flow the client needs. Step 1 is identifying those lifestyle cash requirements. Before calculating taxes or discussing compensation structures, we first determine how much money the client actually needs to support their desired lifestyle. Step 2 is determining the minimum salary required. This is one of the most important stages in the process. The advisor evaluates whether salary is needed to create RRSP contribution room, support CPP participation, assist with mortgage qualification, satisfy childcare planning requirements, or meet other earned income objectives. Rather than selecting a salary amount arbitrarily, the salary is intentionally chosen to support specific planning goals. Once the salary requirement has been established, we move to step 3 and calculate the remaining corporate profit. This helps determine how much income remains available for additional planning opportunities. Step 4 focuses on identifying any additional cash requirements beyond the salary amount. If more cash is needed, we proceed to step 5 and determine whether a bonus or dividend is the most appropriate tool for extracting that additional income. Finally, step 6 is creating the hybrid compensation plan by combining all of the components into a complete strategy. Now look at the right side of the slide. In addition to personal objectives, advisors must also consider corporate objectives. These may include retained earnings, tax deferral opportunities, business growth, investment capital, and overall financial flexibility within the corporation. The best compensation plans balance both sides of the equation. Notice the section at the bottom comparing a common mistake with a better approach. A common mistake is starting with dividends simply because they appear attractive from a tax perspective. The better approach is to determine salary needs first, then use dividends strategically after those planning objectives have been addressed. This creates a compensation strategy that aligns both personal and corporate goals. The key takeaway is simple. The simplest compensation strategy is often salary for planning needs and dividends for everything else. Salary helps create the foundation. Dividends provide flexibility. And when combined thoughtfully, they produce a compensation plan that supports both the client's current lifestyle and their long-term financial success.